Welcome and thank you for joining us this morning for our fourth quarter Greater Milwaukee Foundation Investor Briefing. My name is Joseph Brooks and I serve as the Senior Director for Donor Services. We've got a big group this morning, and on behalf of all my foundation colleagues, we are grateful for your partnership with the foundation and for your time this morning. So before we get started, one more friendly reminder about the Q&A feature at the bottom of your screen. We invite your questions and we will get to as many of those as we can following Mike's presentation. So to get us started this morning, it is my pleasure to introduce Ken Robertson, who serves as GMF's Executive Vice President, Chief Operating Officer, and Chief Financial Officer. So Ken, passing it to you.
Thank you, Joseph. Thanks everybody that's joining us today. I know you're used to hearing me at the end of these briefings, but with market conditions being what they are, I thought I'd jump out up front and share some thoughts. And I'll pass this baton over to the able hands of Mike Miller and his crucial team for analysis. You know, facts really matter. We are at no doubt at the end of a very challenging year. But as hard as it is to hear, it's just a year. And we know that we're in this for the long run. That doesn't mean that when we open our statements, we still don't feel the sting of this tremendously down market. But most of us have seen these down cycles before. And performance does bounce back. It helps to be reminded of some facts. You know, looking back over the last 3 years, our foundation assets have grown by double digits, heavy double digits over the last 3 years. 19%, 16%, 14%. I'd say those are some pretty good years. Still, that doesn't completely soften what we're seeing today. You know, another way to look at this is that if you look at the last 2 decades, so you look at performance from 2002 to 2022, we've had 15 years of strong market performance, 15 of those 20 years. So given our historic performance and the confidence that we have in our investment partners, we believe that we'll see light at the end of this tunnel. As always, we'll continue to spend wisely and responsibly. Now's not the time to reduce our investments, but we'll be smart and focused on the investments that we make. And we'll make sure that those investments yield a strong return for our community. We've been at this for over 100 years, and we've seen our fair share of ups and downs. And it's for sure that we're not going anywhere. So thank you for your partnership. We're doing this together. I'm going to turn things over to Mike Miller and the team from Crucial. Welcome, Mike.
Thank you so much, Ken and Joseph. It's a real honor to be with you all here today. And as Ken said, in this very challenging and difficult climate, so we are both upset, as I'm sure many of you are, with the way markets are behaving and would prefer that be different. But as you'll hear a few times from me today, we also happen to know or think we know that when markets get like this, it creates amazing opportunities for patient long-term investors. And ultimately, that's really what drives our long-term outcomes. So I'll spend quite a bit of time today walking you through how these kinds of conditions have impacted the foundation's long-term returns and their short-term returns, and also talk a little bit about what's happening in markets with a little bit of advice that I hope will be useful to all of us on this call. So if we can go to the next slide, Ryan. So here's the bad news, which is the portfolio's returns, which are the blue bars. And you can see the 2022 experience that we've been talking about, which is down nearly 20% here, as you can see. And you can see we've compared that to 3 other indexes, which we've done at all our meetings historically here. The first is the gray bar, which looks very different than anything we've seen in a long time. That is the Consumer Price Index plus spending. and has obviously become a much more difficult benchmark than we have seen in many, many years. And we will definitely talk about that a little bit today. The red bar is the simple mix of 70% stocks, 30% bonds that the foundation and the committee look at just as a measure of what would a long-term investor theoretically do if they just wanted to pick two index funds. So that's an important benchmark. And then the green bar is what we call the custom market benchmark. And what that is it reflects the investment committees and the board's asset allocation strategy. And the index that we're showing you takes the mix, which we will talk about a little bit later, and assigns a simple standard market index to each piece. So the difference between the red bar and the green bars, the red bar is a very, like I said, two index funds. That's it. The green bar instead reflects the actual mix of the foundation by policy over time. So if we turn to the next slide, thank you, Ryan. So this slide takes what you saw before, though, and converts it to what I think is really much more important, which is it takes into account what time does to this equation. So short-term results on a page like the one before look extremely important, and that's what we're feeling and thinking about right now. And it's nothing wrong with that. That's how we are. What the difference in this slide and the slide you saw a minute ago is quite simple. The slide before were per year numbers. So we just take basically what we call the annualized number, and these are compounded. So for example, a compound return would be take the 10-year return on this prior slide. You don't actually multiply by 10. That's not how the math works, but just simplistically, you can multiply by 10 and you get the return because it was a per year return. And the reason this is important is what it does is it lets us extend and think about the impact of long-term results versus short-term results. Because at the end of the day, while we all need to consider both, the long-term results, as Ken really aptly described before, are what drive long-term philanthropy and long-term impact in the greater Milwaukee region. So if you look at this slide, so now again, a couple things stand out. So first one that stands out is that the year-to-date losses, the one-year losses we showed you here, don't actually look quite as severe as they've done on the other page. And that's because put against all these very large gains over time, you do see a very different picture emerge. Now, the second thing which stands out is that we can also see the way the blue bars are ahead of the red and the green, and the gaps actually start to look a little bit bigger, particularly over those 5, 7, and 10-year periods than you saw on the prior slide. And over 20 years, it looks extremely large, the gap that you see there. And that has been the skill of the foundation's investment committee and the advice that we have given and the work of Ken and the management team at the foundation as an amazing team putting together a strategy and a structure and discipline that's worked as well as this one has. Now, you can also see something not so positive for most of these periods, which is we have now fallen behind the CPI plus the spending rate. This is where another concept I'm going to talk about today a little bit called endpoint sensitivity comes into play. So this is one of the worst moments you can imagine to look at something like this. And I say that because inflation's been running very, very high. As we've seen yesterday, it's starting to come down, and we'll talk a little bit later about that. I think it's going to come down quite a bit more over time. That's almost a guarantee. And at the same time that's happening, capital markets have been as weak as they've been. So that combination of spiking inflation and weak markets has created a very weak one-year number, and that's kind of bled across to all the other numbers on this page. So this is why we tell you this is not the outcome we're looking for 10 years, but I will say this. As you look at that 10-year column carefully, what you see is the shortfall is there, so we need to recoup it, and we will. And the second thing you see, though, is that the blue bar is well ahead of the red and the green bar. And so we've accomplished something that we also think is very important here, which is we have achieved essentially, we've minimized the damage of this very difficult one-year period in our 10-year return. And that lets us, if we're closer and we stay in the game, then we can get back to what you see over 20 years, which is success, where the foundation's actually added value over the CPI plus spending, excuse me. And you can also see that the red and green bars, particularly the red bar, didn't come anywhere near achieving that goal. And that's where the difference of the foundation strategy comes into play and how successful it's been. So we turn to the next slide. So I showed you a minute ago performance compared to benchmarks. The one-year number did not look good. And this slide basically confirms a lot of different things you saw. So now we're switching gears. We're not looking at a benchmark anymore. We're looking at how did the foundation pool perform compared to a universe of other endowments and foundations. There's about 900 endowments and foundations in this universe, and it's called the Investmetrics universe, which as you can see at the bottom here. So the green bar in the middle shows you how the foundations performed compared to that universe over a variety of periods we just looked at a minute ago. And you can see for the 1 year period, it's exactly what you saw on the other page. We have not had a great year. We actually don't think we've made any investment mistakes, frankly, not the ones that are hurting us. The things hurting us in the portfolio now are mainly, we would say things that are early and will be the source of future outperformance. But right now, that's what they look like. And we own that, of course. And if you look at the gray bar above it, that shows you how the foundation is ranking compared to other endowments and foundations. For the latest year, we're behind the benchmark, we're behind the median. So we're in the fourth quartile, which is the bottom quartile. So basically about 80% plus of endowments and foundations have outperformed the foundation over the last year. We obviously are not happy about that and not proud of it at all. However, you do sometimes have to be different than other people, and you have to do it. And sometimes you'll be a little early, and that doesn't make you wrong. And you can see that over the 3, 5, 7, 10, and 20 years where we've been in the top quartile, including this 1 week year at the end, as you can see. And over 20 years, we're particularly proud of the fact that the foundation portfolio has outperformed about 92% of other endowments and foundations. That's the first with the asterisk next to it for top decile. Now, for those of you who look at this and rightfully so say, oh, a little disappointing, I would agree. But I would also tell you, we have been here before. We have been in the fourth quartile for 1 year periods. We've actually been in the third quartile, if I recall, for 3 year periods. And we don't let it phase us, because at the end of the day, as long as we're making smart decisions with a good strategy and a set of criteria we operate under that are long-term successful, we'll tolerate some short-term discomfort. What we will not do is try to hug a benchmark or hug a universe so that we don't look too bad in the short term. Because I think a lot of times what people fail to appreciate is when you do things that are comfortable and easy, frequently you pay a long-term price for that. And the impact of your dollars on your community is far too important for us to pay any price for a little short-term embarrassment for Mike Miller, for example, or anyone else for that matter who has to report these numbers. So if we go to the next slide. This is a way of trying to show you another interesting aspect. So yes, we're going to have disappointing short-term performance, but if it feels like a coin toss to everybody, hey, sometimes they look good, sometimes they look bad, that is not a good outcome. Because first of all, there's no way to be confident in a strategy that sometimes looks good, sometimes looks bad. You need to see a lot of winning. You need to see kind of the Packers winning a lot of Super Bowls, for example. So what you're looking at here is a plot of how the foundation's performance has been over rolling 3 year periods compared to its benchmark, that numbers we showed you earlier. So I showed you earlier, we're underperforming the benchmark this year. So this is looking at from all the way back to the 90s, how have we done compared to that benchmark? And it's very important to think about a few things here. So the first one being, you can see in the late 90s, actually, we had, I'm sorry, I'm struggling with my own graph here. Yeah, this is in the late 90s, I'm sorry, I can't read. You can see that the portfolio struggled in a very strong value growth-oriented bubble in climate, at the time. The foundation at that time held its own, and you can see that the period that followed, so when the blue lines are above the midpoint, that means that returns are above the benchmark, just to be clear. So we had that difficult period during the late 90s in the bubble, which we'll come back to a little bit later. And then we really caught up quite well after that, which was important. And actually, one of the things I want to keep highlighting for you is you can see some pretty severe underperformance, but then you can also see the portfolio outperforming by even larger margins than it underperformed by, which I think is also really, really important here. So you can have some disappointment, but then when things recover and calm down, do you do better than when you did badly? And that's going to come up several times in the next few minutes. But now, after that, we tried to actually, the foundation, the committee, and Crucial have consistently tried to improve the work we do and tried to smooth out some of the rough spots. Our strategy is a little more complicated today. And one of the reasons it was made more complicated is we did want to avoid some of the feast or famine elements you see of the numbers on the left-hand side of the page. And so since that time, what's really interesting is the way in which the portfolio has almost, not consistently, there's some shortcomings there, but very, very frequently outperformed its benchmarks over the last really 20 years or so. And that's important because that's how we think we build the confidence of everyone in this on this call and elsewhere, that this is a good strategy because it works most of the time. You can see actually one of the few times it hasn't worked, and this is very important for today as well, is to the far right-hand side. You'll see that one little bar peeking down below. Well, that I believe is the March 2020 bar. So when you get into, oh my gosh, the world is shutting down because of COVID, yeah, long-term investors almost never look smart when there's something really shocking and bad in the short term. And so that didn't surprise us. Of course, you can see what followed was a massive recovery, which follows the same pattern as before, which is bigger outcomes on the positive side than on the negative side. So if we go to the next slide, We wanted to show you a few other things that I think are really important here. So the slide before, I believe, was the rolling 3-year numbers. So now we're looking at different time periods, 3 years, 5 years, 7 years, and 10 years. It's the same analysis. Literally take every single 3-year period from 1997 to 2022, take every 5-year period, take every 7-year period, and take every 10-year period over those periods of time, and then measure a few things that you saw graphically before, but now I want you to see the numbers. So the first thing, on the slide before, rolling 3-year returns, the 3-year batting average is 73.3%. A lot of that damage, as you saw, was in that early period where we were a little bit just more of a pure value investor, and we've changed since then to some degree. As you go to the right, you'll see that what's very interesting is the hit rates go up and up and up, which is consistent with our philosophy, because again, we're not trying to make any short-term forecasts. We don't really know what the markets are going to do next. We find them unbelievably interesting and mysterious at the same time. And because if you have that perspective, you don't try to guess what they're going to do. And so what happens if you're a good long-term investor, you do look foolish over short periods of time because markets do something that seems insane to you and it continues to do insane things. But eventually insanity does fade to distance, into black, so to speak. And therefore you end up with longer term horizons that are more consistent way to measure whether you're doing a good job making investment decisions or not. And that's why we're really proud of 5 years, 7 years, and 10 years in particular, a 98% success rate over 10 years, which just gives you this, really provides a really interesting window into how time for good investment strategies heals everything. Now, the next thing you'll see underneath that is what we call the median outcome. And what that refers to is how did the portfolio did cumulatively compared to its benchmark? Because another question you have to ask yourself, so let's put aside the 80, 90% success rates for a second. You know, we are hiring active managers. We're using complicated strategies. We're not, and we're paying fees for all these things. And so this is not insignificant. Now, everything I've been showing you, just to be clear, is net of those fees, but it's still, they're still there and we're still paying them. And by the way, we pay them whether the results are above the benchmark or below the benchmark for the most part. And therefore we need to answer for the question of, is it worth it? And so what you see here is an interesting analysis of that, which shows you that basically, for example, over 10 years, this is cumulative, so you can divide it by 10 if you want, about 1.2% per year of average outperformance has been, over 10-year periods, has been the outcome that we've seen from this strategy, again, net of the fees. And we would argue that 12 percentage points of additional capital in your funds are very much worth taking the risk of not getting that done. The other thing which is really interesting is the best outcomes versus the worst outcomes. And this is the point I wanted to make earlier about skill, and I used the March 2020 example a moment ago. What you can see here is when we do well, all we did is we took every single measurement period for the 3, 5, 7, and 10 years, and we said, okay, what was the best one? And that's the best outcome. So it's not the expectation. The expectation is closer to the median, but just best versus worst is important because every time I see you all quarterly, every time I see you, I show you a snapshot in time. And this is all the snapshots in time summarized essentially. And it's really interesting to think that when we do really, really well, it's a 30% advantage over 10 years. And the times that we've messed up, that aren't too many, I'm glad to say, the downside was 2.7%. So again, remember, that's not 2.7% per year, 2.7% over the entire 10-year period, about 0.2 to 0.3% per year. So again, that's another sign of a strategy that has been successful in the foundation's returns. Again, high batting average, meaningful value added, and the best case scenarios are dramatically better than the worst case scenarios over all these periods of time. So these are hopefully things that I know give us comfort, I will tell you, and I hope give you confidence. So we turn to the next slide. So how do we do it? For those of you who've been on these calls before, I'm sorry, I know I'm a broken record, but what we do is not complicated and it doesn't change that much. I'll talk about what changes in a minute, but not that much. So the first point, we're long-term thinkers. The second point, even at times like this, we are not tempted to think we know what's going to happen next. I've always found it interesting that when markets get extremely difficult, people there's a tendency in psychology and behavioral psychology known as recency bias. And what recency bias teaches us as individuals and human beings, we all have this, by the way, it's not a flaw. We basically all assume that what's happening in the here and now will persist. And that's a natural human reaction to things. I'm not sure why it is the way it is, but it is. And so when you get in a difficult market, people slowly but surely become confident that it's going to stay difficult. And that's a really big problem. And the point I would make to you is that things don't get more predictable in difficult times. In fact, arguably they get less predictable. And that's what we're seeing in the markets right now. So we do not get tempted by that. But at the same time, the reason people try to deal with what's the short term like is they want to control risk. So there's a lot of ways to do that. The only ways we're willing to pursue are ones that don't cost us long-term return. So for example, going to cash in a difficult market like this one might help you, but it might not. And if it doesn't help you, you're going to be losing a lot of long-term return. Because as we've seen this last couple of days, for example, just to give you an extreme example, markets can change. They may not be changing, but they can go up very quickly when things get really depressed as they are now. So a long-winded way of saying that we instead control risk through diversification. And that's a really critical part of the strategy. And by the way, it's one of the reasons that you can always find something that's done better than we've done. And that's because it's less diversified than us. And we are not interested in being concentrated into any specific strategy for the entire portfolio. So we turn to the next slide. Here's the GMF mix of the pool. We've shown you the prior and the current. So the committee reviewed this a meeting or so ago. They met yesterday, so it wasn't yesterday, it was the meeting before. And you can see here that the portfolios only had some very modest shifts. And so the committee was well aware of the market climate. It was 2 meetings ago, excuse me, when they made this change. And what you can see is we did not change the equity exposure because equities absent the S&P 500, which we'll get to later, are extremely interesting today, if you ask us. The bond portfolio was reduced a little bit. Now, this was done prior to rates spiking as much as they did in the next few months, because it was done, like I said, earlier this year. But nevertheless, we cut back bonds a little bit. We also cut back the hedge fund portfolio, not because hedge funds have been a challenging place for us this year, but long-term, they've been very successful. We didn't cut them back because they're so terrible. We cut them back because we needed to fund more private assets, which is what we really were concerned with doing and wanted to make sure we got right. So the expectations for returns on the equity side have been going up in this very difficult market. The expectations on the bond side have been dropping a little bit, as you can see here. And then what we also wanted to do is we wanted to fund a higher exposure to private assets and the foundation's mission investments. And so that gets us to this change we see here, which we're really looking forward to, by the way, the committee's next discussion of asset mix, because something major has changed since we did this one, which is interest rates are much, much higher than they were then. And when rates go up, one of the things I want to give you as a little bit of a source of comfort for next year, I hope, is that higher interest rates mean 2 things. One, you're making more money on bonds, so that's good. 2, some of the volatility you've seen in the bond market this year probably has less of a chance of occurring next year because you started higher rates, which means you get more income. And 2, I mean, rates could go up a lot again, but they've already gone up a lot. So there's a limit to how far they really will go up, in our opinion. So that should give us a more stabilizing bond portfolio than we've seen this year, because it's been a very tough year from that perspective, as you know. The last thing I'll say on this, if you think about this mix, it's basically 88% equity and alternatives, and particularly and those parts of the portfolio are how we get to that CPI plus spending rate. The bond piece is small because rates were so low. And again, as they go up, the committee's going to have I'm sure, a spirited debate next year. And I can't wait for it myself. I'm really excited about it because it feels like it's been a decade or more since we've had an interesting discussion about bonds to see how that turns out. So we turn to the next slide. So I showed you something earlier. One of the things I think has always been something I will tell you I'm personally very proud of, and I know the committee is, and I hope you are too, which is that we've never actually at the investment committee had to have a conversation about whether we should just put the whole portfolio in index funds. And the reason we haven't had that conversation is because the portfolio's been beating indexes so consistently over time. And so that's something that we're very proud of. And as you might guess, as the foundation's advisor, it consumes an amazing amount of our time and resources to try to make that happen and keep that happening. So how do we do it? So the first thing is we try to just really work really hard, and we try to think about avoiding mistakes that are obvious, and then we'll just make mistakes that are less obvious, because we do make mistakes. 3 things. We have a very high bar. We don't hire managers who can just outperform the index by a little. Because that doesn't really, first of all, why take the risk? This is my first question. I'd rather just own the index personally. Secondly, we're going to make mistakes at the manager level. We've made plenty over all those successful years you saw. We've made plenty of investment mistakes with managers, just hire people who were not as good as we thought they were. And when we figure it out, we get rid of them, of course. It's not a lot of that, thankfully, that happens, but it does happen. So when we make that mistake, we need the other parts of the portfolio to do the heavy lifting. And so we need big premiums from our other managers to make sure that you don't actually, when you look at the total portfolio, see any problem because we picked XYZ manager that wasn't as good as we thought. The second point is the managers must have an edge. They must be able to do something or know something or think something or behave in a way that's different than other investors. We're going to talk about something called variant perception a little bit later. It's an extremely important thing about investing that people fail to appreciate. And I'll tell the story really simple. There's an old expression in the investment business that risk is greatest when agreement is greatest. And that's basically, so if you find yourself investing in something that literally everybody talks about and everybody likes, I'd be very careful about that if I were you, because that's too much agreement. So variant perception is a gift that some people have because they see things a little differently than the crowd and they find opportunities. Now, not every time you think something different are you right, But when you find something different and you're right, it's an incredibly powerful force. And it's, you want to sum up everything we have under edge, it has to do with variant perception. There are places we don't go. We don't like leverage. We don't like people who have destabilizing liquidity structures. Think about mutual funds that own a bunch of illiquid bonds, for example. That's a really scary strategy because everybody can take their money out anytime they want, and the bonds may or may not be easily sold in the market. That's a destabilizing liquidity structure. And you might see the one that seems a little odd is excessive risk aversion. So what does that mean? Excessive risk aversion means somebody who's always just too cautious. And sometimes caution is good. And we like caution, just to be clear. But where we don't like it is if it's going to lower the returns a lot. If you're just going to be always trying to protect short-term outcomes, you're probably going to generate weak long-term outcomes. And we don't have any tolerance for that. We'd rather own the index again. So next slide. So I mentioned variant perception. Here it is. So we've talked many times about the importance of diversity in this portfolio. So there are different ways to get to variant perception. And we have identified three that we're particularly focused on. The first is location in the world. That's why we have managers who are located all over the world, because we think that people sitting in different geographic areas see things differently. And I think their flow of information is different, their lives are different, all kinds of things give them a different view. And I think that's extremely important. The second thing that drives variant perception is age. Having spoken to, and I'm 56, so having spoken to managers who are older than me and some that are barely older than my kids, I will tell you, it's amazing to see how, first of all, how much talent spans generations, which is not surprising, but when you see it live and in person, you're like, wow, this is really cool. The second thing, though, that you see is that younger investors have clearly less experience. They also understand things that older investors don't understand necessarily. And so they have a real role to play. And they also, as a group, tend to have a very long time horizon. And there are obviously exceptions to that. Older investors, more mature investors, bring a lot of other cool stuff to the table. One, experience. Having seen a few things does not hurt you as an investor, I can assure you. The second thing they bring to the table is they too can have a long horizon, but it's a little less natural because we're all human beings and we have a life cycle. But with that said, what we're doing is we're blending them together with a bias, by the way, towards the older, more mature portfolio managers, because we do like experience and I think it has real value, but it shouldn't be the entire toolkit you use, which gets us back to another thing in the investment industry, which is that most people in the investment industry are very heavily reliant on white male portfolio managers because that's the structure of the industry. And by doing that, you're missing out on this incredible group of talented people who are not white men. Women and people of color and ethnically diverse individuals have so much to bring to the table. Lives are different, perspective is different. And if you remember, age, location, gender, and ethnicity create variant perception. That's our strategy. If you want to go back and say, how come the portfolio has been so much more stable over the last 10 years relative to beating its benchmarks? This is a big reason for it. People seeing things differently, generating differentiated return streams. I cannot tell you how important this is for a portfolio. In fact, when you're not doing it, you're missing out, and that's a real shame. So go to the next slide. Here's the report card. Very hard to read. I can't even read that. I think it's 26% now in the hands of, oh, thank you, or 20%, excuse me, in the hands of diverse managers, which is really important. We've listed the firms that are diverse here on the screen. You'll see the diversity criteria. You'll see the asset class, and they span asset classes, and we'll continue to expand this. The crucial structure is extremely focused on finding great managers, and we have found great managers across, again, age, location, and ethnicity, and gender. And so you will see this list grow over time. I have absolutely no doubt about that. And so we can go to the next, and you'll also see real quickly that 20% compares to as little as 1%, basically from industry studies. And I would leave you with one more thing. You can see the definition underneath here, and I wanted to make sure it's really clear. Our definition here is majority ownership in the hands of, again, women and ethnically diverse people. And the reason that's so important is because what we're also trying to do here is not just hire diverse managers. That's got its own set of great benefits for us, but we're also thinking long and hard about how do we make sure this industry gets healthier over time. It needs more diversity. And one of the ways you do that is you make sure that ownership is part of the equation you use for judging these things and ensuring that we have a strong industry. We're working on a lot of other cool new ideas. Someday I'll get to talk to you about how we expand diversity in industry more. But with that said, we're proud of this. We're proud of the impact it's had on the portfolio. And we can go to the next slide. So let's switch gears to the climate we're living in right now. I know it's an extremely difficult one with a lot of short-term anxiety And so I'm going to leave you with a lot of conflicting thoughts here today, and I'm sorry for that. But as you know, we're very transparent about what we're thinking. And unfortunately, what we're really worried about today is that there's probably not enough long-term anxiety out there. And I hate to sound that way, but that's what we feel. So first point, inflation is risen. And that's a major, major issue for the markets because we've been living in a climate for the last 14, 15 years where central banks have been flooding the system with liquidity and has created a very unusual investment climate, a very profitable one for the most part if you learn the right stuff, but it's not normal. And we're heading to normality here, or normalcy. And that's something that we think is great, by the way. We don't enjoy this adjustment period, but it had to happen eventually. So let's just get it over with, is our thought. The second point, unfortunately, this is the doom and gloom part of the Mike Miller presentation today. Indices, the core indices like the S&P, growth indices like large cap growth indices, they're still very expensive even after the declines we've seen this year. So when they bounce up every now and then, be wary of the fact that they were never cheap. If they're not cheap, it's hard to have long-term confidence in a better outcome. And there are two things I really want you to walk away from today's presentation with. The first is saying, okay, great. I think the Greater Milwaukee Foundation has a really good investment strategy, and they've really proven a lot to me, and I'm looking forward to seeing it continue to do well. That's the first thing I'd like you to walk away with, a lot of confidence in what we're doing and the committee's doing. The second thing I want you to walk away with, which is perhaps more important for you personally, is to recognize this third point. A lot of people right now are basically saying, when can I go back into the same tech stocks or the same speculative companies that I went into before and made me so much money? And I don't know what will exactly happen, of course, but history does teach us something in every single cycle so far, which is that after you get a big shock, like we're seeing in 2022 to the markets, the winners that come out of that shock tend to be different than the winners that went in that preceded the shock. So be careful. And so my point here is open your horizons. Think about value stocks. Think about a European company. Think about a Japanese company. Think about an emerging markets fund of some kind. These are all things you didn't want to touch with a 10-foot pole for the last 15 years, but maybe they'll be the place to be for the next 15 years, one or more of them. And I think that's something I hope you'll all take to heart and do some work and find something new, because what worked before, it might work again. You can't, there are no laws, but the fact is that odds are it won't. And we turn to the next slide. Just wanted to illustrate this point I made a minute ago about the last 14, 15 years. So this graph is a look at from basically almost the last 100 years, a little short of 100 years. You can see 1928 to 2022, the S&P 500. So one thing that's really important about this graph, and it is the most important part, just to be clear, is it pretty much goes up over time. And I don't know, it's hard to read, I know for most of you, you have the slides separately, so you can look at them all later. Most of these things are not good events. And so with all those bad events occurring, essentially, one of the things that this slide is meant to show you is, hey, you know what? Market basically still goes up over time. So it's the quote unquote, don't worry about it picture. And we find that very important to think about for lots of reasons. But the key point here is that, yes, if you have a very long time horizon, you don't have to worry. And even with the S&P overvalued today, you don't have to worry. But if you also look carefully at the graph, you see a second thing, which is there are long periods of time. You can see it in the 20s, 30s, you can see it in the 60s, you can see it in the 70s, you can see it in the 2000s, where the market doesn't go anywhere, or it goes up very little, or even goes down, depending on which points you pick. And these are 10, 15-year periods sometimes we're talking about here. And so those are, for some of us, or many of us, or maybe all of us, that's a lot of time. 30 years is a lot too, of course, but 10 isn't not a lot. And so we think about the fact that the idea that the S&P is always going up, well, it's not really true for what most of us would consider a reasonable period of time. Now look at the far right-hand side of the graph. This is the last point. You see the way it just keeps marching steadily higher? That's quantitative easing, which is the Fed buying bonds to depress interest rates to hopefully stimulate growth. That has created what we consider to be a pretty significant asset bubble today, which is called the S&P 500 and large growth companies like, I won't name names specifically, I don't want to pick any companies. But so long story short, the problem with that era is it's been wonderful for us, but it's not the market. It's not history. It's just this one segment of history. And we all have to acknowledge the fact that, yes, we could get back to the party in the next few years. Who's to say we won't? I would hope we will. But the odds are we won't. And the second thing is, what I know for sure is it's not a permanent condition. We'll go back to something more difficult again. And there's no time better to recognize that something might be over before it, disaster strikes. So be really careful with how many lessons you take away from the last 10 to 15 years in the markets. It's not been the normal. It's not a normal time. So next slide. So one of the issues, I keep referring to the S&P being overvalued. For those of you who watched the session we did 3 months ago, we had a graph that showed that even after the drop through June 30, the S&P was still 40% overvalued. That's still about true today, by the way, because the market's been bouncing around a little bit, might even be a little bit more overvalued today. And we use something called the Shiller ratio, which is a 10-year average of inflation-adjusted earnings. And what the Shiller ratio has shown is that, again, I mentioned this before, the market's about 40% overvalued. Now, it doesn't have to go back to fair value. I'm not saying it's going to drop 40%. The more likely scenario from here, by the way, the more likely scenario is it's just not going to generate big returns, number one. And number two, it's going to generate returns that are well lower than other very interesting alternatives that have done far poorer over the last decade, but now are seeing their day in the sun potentially. And you want to own some things that are coming out of the shade into the sun and not just everything that's kind of fading into the background. So this chart here is meant to give you a little bit of sense of how distorted the markets have become. So what you're looking at here is the top 5 companies and how much of the S&P 500 do they represent. Now, for those of you who don't think about index construction all day, let me just give you a quick primer on one thing here, which is that the way this works is the size of a company determines its weight. And so the size of the company is its market capitalization. So market capitalization are the number of shares outstanding times the price. So the stock does really well, its market capitalization usually grows, it becomes bigger and bigger and bigger. So this graph shows you a couple things. The first is that the top 5 companies, there are 500 companies in this index, right? But 5 of them represent about 20.5%, down from 24% of the index not that long ago, as you can see here in 2019, excuse me. And this is really interesting because take a look at the history. Even in the late 90s, which was a pretty big bubble for big stocks like Cisco at the time, the index didn't get that concentrated. So the risk level, concentration, popularity are combining here to create risk. So just to give you the one that stands out, Apple alone at one point was 8% of the index. And you might say, well, what a great company Apple is. And it is a great company, but it got to 8% of the index because the stock dramatically outperformed everything else, and leads to the question, how fast can a 2.4 at the time $1 trillion company grow? It'll consume the entire economy. I don't think I can buy another Apple device. I don't know about you, but the fact is that the reality is that popularity is the same statement. Risk is greatest when agreement is greatest. And when the index gets this concentrated, it becomes riskier, and that's not a good sign. So go to the next slide. So I mentioned value stocks. Maybe value stocks about to have their day. And you can see why people look at you like, I don't think so. And the reason is, take a look at this graph. So this shows you the annual performance of value stocks compared to growth stocks. So when the line is above the midpoint, growth is outperforming value. And when it's below, value is outperforming growth. So it's really interesting to look at what's happened here. First, we have had to the right one of the most amazing periods for growth stocks in the history of this 30-some-odd-year history we're showing here. And it's fascinating to think about how strong growth stocks have been. And part of that is because they're growth stocks. They're better than value stocks. Nobody would argue, hey, I'd rather own a bank and not Apple. I mean, who would say that? But the reality is, though, investing isn't about what you own. It's also about what you pay for things. And this huge run-up for growth stocks here has basically been in part because the companies are better, but also in part because they became more popular. And I'm going to show you that in a minute. But what I want to leave you with is, it's been a long time since value stocks did as well as they're doing this year. And this has actually expanded, I think, since this chart was done. And last time it happened, which is separated, is shown in the 2001 column. It was a pretty decent run for value stocks. It doesn't compare to what we just saw for growth stocks last few years, but that's not bad what you're seeing. Keep in mind, a negative 1,000, that's 10 percentage points of outperformance. So it's a significant number. And all we're saying is there is a cyclicality to this. And maybe this cycle has just started, which gets to the next slide, because I think what you pay for things is extremely important. And here what you're looking at is, how does the market value growth stocks versus value stocks? So PE is price to earnings ratio. So what's the price divided by the earnings? Think about it this way. If I have $1 of earnings and I own a company and I pay $10 for that dollar, I have a PE of 10. If I pay $20 for that dollar, I have a PE of 20. Now, why would somebody pay 20 for the same dollar if they can pay 10? And the answer is because they think the dollar is going to grow more quickly as an earnings stream. And it's worth paying more for something that grows faster. Nobody would debate that. So I told you before that we have very strong fundamental valuation driven thinking in our portfolio and our thoughts. That doesn't mean we don't own growth stocks. We just don't want to overpay for them. We like growth stocks. Who doesn't like growth stocks? They're better. But look what this chart is showing. So this goes back to the late 90s, and it shows you the valuation of the growth index compared to the valuing. So NTM, just so you know what that means, that stands for next 12 months. So what you're looking at is the long-term average is about 1.5. I'm rounding up a little bit here. So essentially what's happened is growth investors have paid $1.50 or 150% more than value for the same dollar of earnings. So pay 15 times instead of 10 times is the way to think about that. That's the long-term average. You can see in the late 90s, it went all the way up to 300 times, not 150 times. So it doubled the long-term average, and predictably it crashed after that. This time wasn't as severe. We only got to about 1.9 to 2 times, but it's coming back down to earth again. And the point is, people are still, even after the declines you've seen this year, paying a good 30, 40 percentage points more of price ratio they pay for the growth. And that only assumes we get back to the average. What if we go back below the average, like where we sat for a long period of time from 08 to 16? If you're a growth investor, you should be worried about this. I will tell you right now. And this is all tying into the same idea that what wins next might be different than what won last time. And so be really careful with that point. Next slide. This is one I think we looked at last time, so I'll make it quick. This is the plot of human nature, we call it. So the red line is the NASDAQ 100 index. So this is an index of stocks like Cisco, and Microsoft was in that group at the time in the late 90s. And basically it shows the rise and fall of that index. So there's a quick typo on the bottom. It says August 2020 on the very second line, which I'm going to get back to in a second. That should be 21. They had a typo in their graph here. But the fact is that what you're looking at is the red line is, again, the rise and fall of the NASDAQ 100 in the late 90s into the early 2000s. The blue line is our current version of a speculative bubble, which is we use the ARK fund. So the ARK funds are an ETF or family of ETFs. This is the ARK Innovation Fund. And by the way, I don't want to really sound like we're picking on ARK here. ARK is only being used here for two reasons. One, very prominent ETF, lots of good marketing. And two, an ETF, which has daily pricing. So I can tell you right now, I can find you plenty of investors who've done far worse than the ARK funds, by the way. And so picking on them, I don't want to make them the poster child for this kind of investing, but it's very prominent, very easy to plot this graph because, again, it's an ETF, so it has daily prices. So that's why we use it. So I don't want to make this about ARK per se. But what you can see with the ARK funds, the ARK funds, by the way, own more speculative innovation type companies is how they would describe it. And a lot of these were the COVID winners, by the way, as we call them today. And as you can see here, what makes this graph so interesting is that it's basically showing you what human nature looks like. Everybody got really excited. And it's amazing to think, and I'm a statistician, so 2 data points does not prove anything, but there are 2 really interesting data points. So we take them pretty seriously. Look at the way those 2 lines go up, pretty much the same. And what's interesting, this is not what we call a dual scale graph in statistics. So it's not misleading. It's one scale, takes the same amount of time to get to the peak and almost rises to the same amount of extent of same degree, excuse me. And then look at the crash. It's almost the same story. They're not on top of each other. They would never be, but they're awfully close. And it's incredible to think about what human nature looks like. We get too greedy. We get too fearful. The only thing I would leave you with again is saying one more time, if you're waiting to buy innovative stocks, innovation's good, but make sure you know what you're paying for it. And the next winners might not be the same as the last. So we'll go to the next slide. I'm going to wrap this up because we have time for your questions. Foundation's game plan is very simple. We stay diversified. So when the ARK funds and speculative stocks are doing well, we own some of the good ones, I think. We don't own ARK, just to be clear. But we don't just own that. We own our European companies, our Japanese companies, and we own our bonds, and we own all our other stuff, because diversification keeps us from having extreme outcomes, which are intolerable and would never let us achieve what you saw earlier, which is this very high batting average success. Philanthropy in your community does not come and go with the tides. It's always there. It tends to become even more significant and important during difficult times, as we know. And so we cannot have a portfolio that is susceptible to great risk that is unnecessary. Second point, which also protects us and protects you, we think long and hard about price and valuation and contrarian thinking. Those are great defenses against risk is greatest when agreement is greatest. And last but not least, by any means, our confidence in this strategy comes from our access to amazing people around the globe. And I mentioned again, variant perception. I can't tell you how important that is. So final slide, I believe, is the Crucial Partners commercial. I think that's it. Yeah, we can skip that one. We are, just to remind everybody, we're a New York City-based advisor. We work largely with endowments and foundations. And the point I really want you to leave you with is we do not invest we're not money managers. We don't pick stocks or bonds ourselves. We pick managers. We do not have conflicts of interest. And that's how we are always there thinking about, I hope, the best interest of the foundations. And when we do make mistakes, it's just stupidity, not conflict of interest. So thank you so much for your time, and I appreciate it. And I hope that wasn't too much doom and gloom for your morning. Thank you.
Well, thank you for that, Mike. We've got about 5 or 6 minutes here, and we've got some questions coming in. So just again, a friendly reminder, if folks do have questions, there's a little button at the bottom of your screen that says Q&A. So just go ahead and click that and then enter your question. So the first one here, Mike, a question around valuations. And the question specifically is, are the valuations of the hedge funds and privates current, or is there more bad news coming when the valuations catch up with the current environment?
Oh, great question. So I know we don't have a lot of time, so I'm going to give you I'll give you a quick answer and then one quick statement. And I'm sorry I probably went on too long in the presentation, plus my technical problems, right? So almost yes. So hedge funds that we own are they are entirely publicly traded securities. So everything's up to date in the hedge fund portfolio. The private portfolio, as the questioner clearly knows, has a lag in reporting. So everything is through June 30. There's a few 9/30 marks that have come into the portfolio, but most of that is not yet in the numbers. But I would tell you, we know enough about what's going on in the underlying private equity portfolios and the way valuation works, which we don't have time to talk about today, I'm afraid. To us suggests that there will be some more losses to report, but I don't even know if you'd notice them. They'll be so small. It might be like another 0.2 to 0.3% of the total portfolio. And I think that's almost the worst case at this point from what we can see. But we will, of course, every time I see you, you will see the returns the way I just described, with everything up to date except for the private equity, which will be about 90 days behind. So thank you for that great question.
Great, thank you. We've been hearing a lot about the tech sector lately, specifically social media, given some recent headlines. How does the drop in the tech sector impact future market performance? Do you see the tech sector as a place to continue investing, or how are you thinking about that?
Yeah. So first of all, technology is a great example of where you can find innovation. You can find very profitable businesses. There's a lot of good things happening for sure. And so it's always part of a good portfolio. On the other hand, technology is also in that risk is greatest where agreement is greatest bucket, which is that a lot of companies, particularly the big ones that we know the best, have been bid up because they're very popular. And I fear that popularity will be their undoing. So yes, there are, and you should invest in technology companies, but I'd be more interested if I were you in the ones that have been struggling and their stocks have been struggling. And if you can assess these businesses, you're going to find some real diamonds in the rough. So that's very important. And then the last thing I will leave you with is, again, that comment from before. I'm sorry, I'm going to keep beating this one up. Also look elsewhere. Technology isn't the only place to invest. There are other exciting things to do. And sometimes, by the way, here's my last piece of advice for you all. A boring business can be a wonderful investment. Something that's just sells home building products, something that might be a bank. If the price is low enough, and some of them are, just their mere going about their business can generate a really nice return for you. And so try to look elsewhere too.
Great, thank you. I've actually gotten a couple of questions from donors recently, and curious to pass this off to you. As we look at the asset mix of the portfolio, the opportunistic, the special situations, could you just share a bit more what that looks like? Sort of what does that comprise, and how does that contribute to an overall strategy, especially sort of where we're at right now in the market?
Yeah, so that's been a sore spot in the portfolio. It's one of two this year, and it's been sore for it's been more sore than not sore over the last 5 or 6 years. So it's an excellent question, and one that the investment committee actually discussed at some length yesterday. So let me answer the question. So first of all, that's where we do 3 things that have not been helpful to us, but will be. The first thing is that's where we use what we call higher octane managers. So managers who we think can generate much bigger returns than benchmarks. Now, you aren't seeing that yet, so that's very important, but I'm going to explain why quickly. The way they do that is they tend to have more concentrated strategies. There might be one investing in Japan, for example. There's others investing in different parts of the small and mid-cap market in the US, et cetera, et cetera. It's a big, broad array of strategies. And the undoing of it for the moment, not for the long term, is that the reason that these managers invest the way they do is they have amazing variant perception abilities. They really, truly take a longer horizon. They see things about a business. Some of them are actually activists where they're changing businesses themselves as board members in some cases, or just very, very influential shareholders. And the problem with that is that they are embracing complexity and uncertainty and patience with these companies. And I got to tell you, my gosh, the markets could not hate something more than all of those things, especially, and I understand it, when the world is about the Ukraine, which it should be, when the world is about inflation, I mean, rates, losses, there's so many things to worry about. A lot of people say, yeah, I don't want to worry about my companies too. I'm not touching that stuff. So it's dramatically underperformed. But the fact is that these managers, it's a diversified group of them, they get this right more often than they get it wrong. And so it's part of the strategy, since it's actually our ace in the hole when it comes to how this portfolio is going to come out of this mess with really strong returns. The embedded returns in that part of the portfolio are amazing. And I cannot wait. I don't know how many, it might take a few more meetings, just to be clear. It's not going to happen tomorrow, I don't think, but I cannot wait to show you how successful that part of the portfolio has been. It's extremely distinctive. And the last thing I left out, these managers do not care what's in those indexes. So the fact is it's so different than the index, which is both its source of pain at the moment, but also its source of opportunity in the future. And that's why it's an incredibly important part of the strategy. And we're, like I said, I wish the results were different. I know you do too, but they will be different. And that's important.
Thank you. We have a couple of sort of related questions in the chat around our mission investments at the GMF. Mike, I don't know if you feel comfortable responding to that, or I could as well.
I probably would rather follow your lead. That's okay, Joseph, to be sure we get this right.
Sure. So mission investments are a way that we're using some of our investment dollars at the foundation for some specific social impact kinds of investments here in Milwaukee, including the work we're doing with the Thrive On collaboration. So, this is something that we get questions on from time to time, including this morning. And it occurs to me that this is maybe something we should spend a little more time on in a future quarterly investor briefing, and something that we could certainly ask Ken and others at the foundation to share a little bit more detail on. So mission investments, it's a way that we're using assets at the foundation to invest locally, primarily for social impact with some projects that we're pretty excited about. That's the quick answer. There's definitely more to it, and we'll be sure to circle back on that in a future investor briefing. So with that, Mike, I think we're actually at time. So thank you again for your time this morning and for your discussion, and thanks to everyone for your questions. So as always, this work definitely takes a team to pull this all off, and we're grateful for all of the partners involved, our finance team at the foundation, our team at Crucial, our investment committee, and of course, all of our philanthropic partners as we work together to inspire philanthropy, strengthen communities, and build a Milwaukee for all. So please reach out to your philanthropic advisor with other questions that you might have, anything that you heard today, other things that you think of tomorrow, especially as we approach the end of the calendar year. So to close today's program, it's my pleasure to introduce my colleague, Maura Cook-Lemensky, who serves as the Foundation's Director of Gift Planning. She'll close the program this morning with some helpful information on year-end contribution strategies, as well as some grant-making opportunities. So signing off here, it's great to spend the morning with you, and Maura, passing it to you.
Thanks, Joseph. I'll kick this off with gratitude. A quick thank you to my colleagues who coordinate these quarterly briefings, and the entire foundation staff who work each day to advance our vision to build a Milwaukee for all. Thanks to all who tuned in to this event, and to our donors who help advance and sustain the foundation's work through generosity. We're certainly grateful for Mike and our friends at Crucial for the sound advice and keeping us plugged into the market activity we're all witnessing this year, acknowledging GMF's investment strategies designed to ensure long-term growth, which we know will benefit our community for generations to come. I have the pleasure of signing us off with a touch of practical information as we move into the season of gratitude and giving. We encourage those of you with donor advised funds at the foundation to reach out directly to your dedicated staff contact for information on recommending year-end grants from your fund. Our team is also ready to partner with you or your trusted advisor on processing gifts, whether to your fund or one of GMF's initiative funds designed to pool resources to advance strategic goals and projects. While the tax incentives for charitable giving under the CARES Act have sunset, there are still a number of strategies worth considering as we round out the 2022 tax year. Gifts of appreciated non-cash assets, such as appreciated stock, allow maximum charitable impact and can generally eliminate capital gains tax and allow for a larger charitable deduction. The bunching or bundling strategy, where you combine 2 or several years of giving into 1 year and itemize deductions and take the standard deduction in the following year or years, may produce a larger deduction and a larger charitable impact. This strategy works particularly well when coupled with a donor advised fund. And if you've reached the age of 70 and a half and have an IRA, utilizing the Qualified Charitable Distribution, or QCD, of IRA assets allows you to direct up to $100,000 annually to reduce an IRA balance that may reduce taxable income in future years, lower your taxable estate, and limit IRA beneficiaries' tax liability. And for those 72 and older, this strategy can also satisfy your 2022 required minimum distribution, or RMD, reducing taxable income for 2022. Finally, I want to invite you to consider connecting with our team to discuss how your charitable giving can join with others as we collectively work toward building a Milwaukee for all through our Greater Together campaign strategies, guided by the Foundation's North Star of advancing racial equity and inclusion. As you reflect on 2022, we encourage everyone to consider how their time, talent, treasure, and ties might advance our community as we aim to achieve equity and access for all, including and especially people and communities of color. Whether your contribution is influencing kindness in others, volunteering for a nonprofit in need, or leaning into financial support of the nonprofit community, we are grateful for your trust in the Foundation as partners and champions. Thanks everyone again for coming. Thanks to Ken and Mike for your thoughtful stewardship of the Foundation's charitable resources. Glad you could join us today. Have a wonderful holiday season and all the best in 2023.